Deciding whether to take a fixed or a variable mortgage rate is one of the most important decisions when buying a house, which if taken lightly could ruin your life. And this choice is not clear at all for most of the people. They don't know the difference between a fixed and variable rate, and especially which is better for them. That's why I have analyzed all the historical data about mortgage rates in order to find the solution to these questions and give you an easy guide to choose. Hi all and welcome to my channel. I'm Nico and I'm an investor since more than 10 years. And here on this channel, I share my knowledge and my experience to help anyone improve his finances. And let me first show you an example of the impact that this decision could have on you. It's 2020 and you've just bought this house for $500,000. And you've been discussing with the bank about the mortgage and they've offered you the two different possibilities of fixed and variable rate. But they look to you the same because the price that you would pay every month was rather similar. Flash forward to 2023, you're struggling to pay your mortgage every month. You don't know how to pay for it. It's too much for you. You don't think you can cover the costs and you're sure that the bank will probably take your house. And in the middle of desperation, you search on the internet and you look how much you would be paying if you had taken the other choice for the mortgage. And what you discover shocks you. You discover that you made a huge error. Because with the other option, you would be paying $1,000 less per month. And this difference could change everything. It could save you from losing your house and to getting in even more debt. And that's how important it is, this choice. Because this is what actually happened to a lot of people during the last year. But before seeing why, let's understand what are fixed and variable rates. And so starting with the fixed mortgage rate, it means that the interest rate that will be applied to your loan will always be the same for the whole length of the mortgage. And this also means that the monthly payments that you will have for the 30 years of the mortgage will always be the same. And for example, you can see in this picture that the interest goes down over the time and the principal goes up. And this is made in order to balance the final payment, which will always be of 599.55 cents. And this type of rate gives two main advantages. The stability, because you will always know what you're spending, as well as you will be protected from interest increases. On the opposite, the disadvantages are that you have no flexibility over it and you can't benefit of interest rates that are decreasing. If we look to variable mortgage rate, as the name says, the interest rate will be variable and will be adapted to the interest rate that the central banks are imposing. And in general, this rate is actually lower than the one for the fixed rate mortgage. But the payment can change over the time. And this gives two main advantages of the variable mortgage rate, which are the fact that if the interest rates go down, you will benefit from that. And secondly, that you will have lower payments in the beginning of the mortgage. However, if the interest rates will increase, your payments will also increase. And it can easily get more expensive than the fixed rate. And this means that you will have to face a higher risk, as well as you won't be able to correctly budget your expenses for the future. So now, which is better? It could be easy to say, as many say, it depends on you. I think it's kind of a useless advice. So what I will provide you is the overall best choice with a clear exception, because this way you will have a base to which you can start and tailor it according to the rates that you have and your financial situation. Because the best choice is obviously to subscribe to this channel, because like this your interest rate will go directly to 0%. No, I'm kidding. But if you like this video, if you find it helpful, subscribe for similar videos. And so the overall best is the fixed rate mortgage. And this because you know what to expect. I mean, you're signing a contract for 30 years. You can't take that lightly and just hope it's going to be fine. This way you will be able to correctly plan your expenses for the future, like for the house and everything else. And this way your risk will be minimal. And so you won't have bad surprises like the bank knocking at your door and asking to give back the house. Because again, that's what happened to a lot of people, unfortunately, during the last years who chose the variable interest rate. And this is even more true if you are tight with your money. Because a lot of people in this situation would actually choose the variable interest rate because you have lower starting costs and they hope that in the future it will be better. But this is just the formula to failure. And that's why you have to choose for the fixed interest rate, because you will know how much you will be spending over the next 30 years. Because otherwise, imagine that from one month to another one, your mortgage payment increased by $500. I mean, if you're tight with money, this just means that you won't be able to pay for it. But so let's now come to the one exception that I identified. And it is that historically, the interest rate decreases. And this is why in the past having a variable interest rate was a great idea. I mean, in the 80s the interest rate was at 17%, whereas just in 2020 it was close to 3%. So from the 80s there was a lot of margin for the interest rate to go down. However, now it is close to the bottom limit, like of 3%. And so there's not a lot of room to decrease. And this is why it is more probable that it will go up rather than down. That's also one reason for which it is better to have a fixed mortgage rate. But when interest rates are higher than like 5-6%, it could be a good idea to have a variable rate, because it's probable that it will go down again to 3%, because this is also what the central banks want, that's their strategy. And over the long term you could benefit from this decrease in interest rate, but you have to take note that you're still having some risk having a variable rate. And so if you do that, you have to be sure that you have the money to pay your mortgage payments even if the rate increases even more, because otherwise you will find yourself in a very difficult situation. And so despite being such an important decision, it only is the second most important one when you want to buy a house. Which is the first one? Of course, whether you should buy or not a house. And so if you want to be sure that you're not going to ruin your life with a bad decision, watch this video. Thank you for watching and see you soon.